Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by the voice of the people, my good friend, Jeff Santoro. Hey, good friend, Jeff Santoro.
Hello, how are you?
I'm good, and I'm really excited about this episode because we're doing something that's a little different than what we've done, but I think will serve our listeners, some newer listeners, and certainly folks that have been following us for a long time, really, really well. This is really reaching into the toolbox, fundamental investing, things that are important to understand and why they're important to understanding them episode.
Yeah, we try to talk about as many different things on the show as we can, but one piece of feedback I've gotten from people that I know in my life who listen is that sometimes I always feel like we're pretty good about explaining things and being a podcast that even a beginner can understand. But I have been given the feedback that we sometimes go a little bit over the head of some people who are interested in the stock market and investing, but not necessarily deep into the weeds like we are. So we're going to take a shot at doing something on this episode that might feel a little beginnerish. So I'd love feedback from the listeners, Jason, to hear, like, is this a good thing for us to do more of in some capacity, or if was it too too easy for the more advanced people? We're just going to try it, see how it goes. We'll try to keep it on the short side. We'll try to keep it high level. But what we're going to do is we're going to go through the three financial statements that you see typically with companies, at least the ones in the states that report on U.S. exchanges. We're going to talk about the income statement. We're going to talk about the balance sheet. We're going to talk about the statement of cash flows, and not go line by line in detail, but just go line by line to explain, like, this is how it works. This is what you're looking at. This is what it means. I'm aiming for, I think you are too, Jason, like, not super deep, but also not so surface that it's not helpful, like somewhere in the middle.
Yeah, no, I think that's right. And before we get to that, we're going to spend some time talking about, what they are and why they're important. I want to encourage people that have been investing for a while, that have never really dug into this, to take the time and listen to this episode, because I think you will walk away from it a better investor. Whether you utilize these documents more is an individual choice. But I think that if one of the things is they can be kind of daunting, Jeff. And I think, if Jeff Santoro, the voice of the people, can understand an income statement, anybody can understand income statement.
Well, I'm going to say two things about that. One is, even though I was late to getting obsessed with investing, I've always been interested in, I don't want to say accounting, but I'm the guy who kept track of, like, where I spent every dime since I was like 19. I was like a Microsoft Money and Quicken user when I was in college. So you can imagine I had a lot of dates. And so, like, the idea of keeping track of finances with, like, things like financial statements, it comes naturally to me. So I was really interested in this aspect of becoming an investor when I, back in 2020, when I really got into it. But I want to start off by just saying, for those of you that find this interesting or want something that's a little more deep than we're going to go, there's a really great book, and by great, I mean boring, called How to Read a Financial Report by John A. Tracy, that I've read it several times, or at least most of it several times, because it does, like, a really detailed job of saying this specific line on an income statement is tied directly to this specific line on the cash flow statement, which directly impacts this specific line on the balance sheet. So if you want to go deeper, I'm just going to put that out there right now. If I remember, I'll put this in the show notes, but How to Read a Financial Report by John A. Tracy, that's the book to get. It's like a $8 paperback. It's cheap and detailed. But it will, I think you could substitute a college course by just reading this book, if I'm being perfectly honest. Like, that's how good it is.
Well, let's go ahead, and we've got other ideas for this sort of content as well. So those of you that enjoy it, definitely let us know if you'd like more. Those of you that don't like it, listen to the next episode. It's okay. You don't have to listen to everyone.
But we do want the feedback.
Actually, no, you want to listen to it. Just hit play and, like, leave your phone in another room and just go away for 45 minutes.
Let the ads run for sure.
Yeah, we need the ads to run.
But also, you can give us your feedback whether you liked it or not.
Seriously, yes, please.
First step, 5-star rating on the podcast apps. Then you can give your feedback.
Yeah, we do appreciate the feedback, though. So without further ado, let's talk about the why and what they are first, and then we can talk about the why.
Yeah. So we're going to stick mostly to talking about the ones you find in SEC filings and press releases for US based companies. So the two, we've talked about the 10K and the 10Q all the time. So the 10K is the annual report. Every company on the US markets gives you that once a year, typically at the end of their fiscal year, Q4. So we're going to get a lot of them in the next month or so from the companies we all follow. And then the 10Q is the exact same thing, but quarterly. Within those,
not the exact same thing.
Sorry, it's the equivalent for the quarterly for each quarter, but it is much less information than the 10K. The 10K has a whole bunch more stuff.
It's also not
audited
by the auditing firm. So it's an unaudited look at the books. The only time you get the audited look is with the annual report in most cases.
Yeah. And it says it right on there. It'll say unaudited statement of income or cash flow or whatever. But in every one of those SEC filings, whether it's the K or the Q, you get three financial documents. You get the income statement, also called statement of income, also called profit and loss statement, or P&L. Sometimes you hear it called that. But basically, that's the one we're going to start with. That's the first one you get. You get the balance sheet, which is always called the balance sheet. I don't remember that ever being called anything else. And then the third one is the cash flow statement or statement of cash flows. Something that says cash in it is usually what that one is called. And they're all important for different reasons. And it's understanding why they're there, what they do, how they work, I think is really important.
Yeah, that's the key. And it's super important to understand the interrelationship between these documents, because companies report earnings. Earnings is not cash flows, right? So if a company buys a piece of equipment, for example, that doesn't come out of earnings. That comes out of cash flows. But when we start talking about the income statement, there's a way that it does start to come out of earnings over an extended period of time that we'll talk about. So the point is that complexity sometimes can be confusing, but it's important to understand the interrelationship between them. So I think that's something that's really important. I agree with you that you mentioned that you can find them in the company's SEC filings. I'm pretty much, if I'm looking at a company's filings, I will go to Edgar or the company's website, investor relations website, to get it. I don't tend to count it from third parties, but there are a lot of aggregators out there. We are big fans of fiscal.ai, which is a paid access for, and the SEC filings are just one of the things you'll find in there, but there's other financial data and things that you can find. But the key about when you're looking at these financials in a tool like Fiscal AI, and you can compare multiple periods for a company, is they're pulling the data from those filings.
Yeah.
Now you might see things like KPIs that are not necessarily in the company's filings. They might be in company presentations and things like that those KPIs are coming from. So generally, if you're paying money to a data provider like a fiscal.ai, the data like that you're going to get is going to be from those SEC filings. But if I'm really doing a closer look at a company that's just reported earnings, I'm almost always going to be, at some point in my process, I'm going to go back and I'm going to look at the income statement, the cash flow statement, the balance sheet, because it will compare it to the prior fiscal period, the year-over-year fiscal period, or in the case of the balance sheet, which we'll talk about a little bit, it compares it to the end of the most recent trailing period.
Yeah, so we're going to talk about them in isolation, but the nice thing about platforms like fiscal.ai is that you can see, every quarter going back however many years that they give you based on the subscription you have. So if you're interested in having this all in one place, do check out fiscal.ai. Use our code that's in the show notes to get a discount on any paid plan. We get a little money, you get a discount. It's a good deal. All right, we're going to use Nvidia as the company to have as an example. For those of you watching on YouTube or on Spotify, because we do the video versions of the podcast there, you'll be able to follow along visually. You won't need to if you're listening while you're driving. We'll talk through it. But for those who like to, see it while we talk, it'll be there. Jason will screen share while we talk through it. We chose Nvidia for a couple reasons. One, it's a company that anyone who's doesn't have their head under the sand right now knows about. But also, not all of these financial statements are created equal in the sense of their complexity. And ironically, for a business that does a complex thing like design semiconductors, Nvidia actually has a pretty easy to understand set of financial statements. Apple is another company. If you want to go look at another one, that's pretty easy to wrap your head around as well. So, all right, we're going to start at the Nvidia consolidated statement of income from Q3 of 2025. So we're recording this on January 20th. We have not gotten Q4 yet. This is the most recent quarter that ended in October. I want to say one more thing before we dive in here, Jason. There was the best explanation I ever heard of this, if anyone wants to go find it, is an episode of Motley Fool Money podcast that John Rotanti, friend of the show, was on, and he talked through this, and I was blown away at how clear it was. So I will do my best to match his excellent presentation. So at the top of any income statement, you'll see revenue. Sometimes it'll be called net sales or something like that, but revenue, I think, is the most typically what it's called. And the easiest way to understand that is all of the income, or I'm sorry, shouldn't use the word income. That's all the money that comes in the door, right? So this is all the money that Nvidia made in the 3 months, and on this also, on the one you're looking at, also the first 9 months of the year. So
I want to insert something right here, and that is Jeff is using the word money. He's not using the word cash or the word cash flow. This is really, really important because this is a revenue you recognize in dollars, but it's not actual cash that's come into the business. This will become more clear as we get into the cash flow statement, why that is. Go ahead. I just wanted to make that point.
Yeah, no, please jump in and interrupt me if I say something that's not clear, or to point out that I am saying something clear. This is a good time to point out that there's a lot of accounting rules that you come across in these statements, and that's why we make the distinction between like accounting ways of thinking about money and cash flow. And it's similar to your own like personal finances too, right? Like your checking account is actually the cash going in and out the door, but something like your mortgage, like some aspect of that is an accounting thing because you are paying that mortgage, but the other end of it is sort of an accounting trick, right? So there are some parallels to your personal finances. So anyway, revenue is just the money that has been recognized by the company as having come through the door. And I like to think of the income statement as you read it from top to bottom, and at the top, think of a round number, 100, and you're just going to keep subtracting things from it until you get to the bottom of it, and that's why it's called the bottom line, right? You hear top line and bottom line, that's revenue at the top and income at the bottom. And it's really easy to understand if you kind of think of it like, here's $100 that came in the door, and I'm going to chip away at it as we cover costs, all right? So the next thing you'll see right below revenue, cost of revenue. This is sometimes called cost of goods sold, or COGS, C-O-G-S, you'll hear it referred to as. And this is essentially what are all of the expenses that the company had to pay out just to do the thing they do. So in the case of Nvidia, right, it's all of the things that you need to sell the things that they sell, like the raw materials.
Specifically to make the things that they sell.
Yes,
right. Because this would not include like their sales and marketing.
Correct. We're going to get to that.
Right. So, yeah.
So like, the other analogy here a lot is like the lemonade stand, right? If you have a lemonade stand, the revenue would be all the money people paid you to buy a lemonade. Your cost of goods sold would be the lemonade mix, the cups you put it in, the water that you made the lemonade with, right? Those are your cost of goods sold. But the flyer that you put out to advertise would not be, right? So there's a distinction here.
The money you're paying your little brother or little sister to run the stand is not cost of goods sold.
But sometimes it can be. And I'm glad you said that,
right,
because
that's true.
There are no rules. This accounting stuff, there are rules. There are things that have to be a certain way, but there's wiggle room. So for example, some companies will count some things as cost of goods sold, and other companies might count that same thing or a similar thing as an operating expense further down. So and all of this information is in the if you read the actual financial reports, the 10Ks, 10Qs, it'll tell you like,
these are the kind of things that you might not find in the quarterly reports, but
they'll be in the
you'll
10K.
find more detail about in the annual report.
Correct.
So
it'll tell you cost of goods sold includes blah, blah, blah.
right.
All right. If you take the revenue and you subtract the cost of goods sold, you get your gross profit. And gross margin is just the percentage of that, right? So again, to use the $100 analogy, if you have $100 in revenue and your cost of revenue is, let's just say
$25.
All right, $25. Then your gross profit is $75 and your gross margin is 75%.
Yep. And I'm using that high margin in this because we're talking about Nvidia,
Yes.
which is an extremely high gross margin business.
Yeah. And that's another important thing. If this were a completely different business, a good gross margin might be 30%.
Right.
If it's a software SaaS company, a good gross margin might be 90%, right? Because they just don't have as many cost of goods sold. All right. So we're going to keep moving here. We got to try to get through this whole thing in about 45 minutes. The next thing is the operating expenses. These can be very different based on the business, but the big buckets you typically see are research and development. Sometimes sales and marketing is separate, and then general and administrative. Those are the three most common sort of big buckets, but these will vary very much based on the business. In the case of Nvidia, they have research and development, but then they combine the other one into sales, general, and administrative. Now, this is where the devil's in the details again, because research and development might make sense, right? Oh, you have to design the next chips. That's research and development. It is. But it's also all the salaries of the people who are doing that work. It's their stock-based compensation, which is a big thing for a lot of companies. It can be like if you send your research and developers to a conference, sometimes that might be under that line, or sometimes it's under general administrative, right? So you have to kind of see where they put those things. And then sales, marketing, general administrative. Sales and marketing is pretty straightforward, right? That's advertising and going out and getting people to buy your products. General administrative is typically a catch-all, and that's a lot of the corporate expense, right? If you have a corporate jet, general administrative. If you run a big conference for your employees, general administrative. That's where that kind of lands. But the bottom line is everything the company spends after gross profit is figured out, that's not interest or taxes, is basically an operating expense. And if you subtract that, you get operating income, right? So you have revenue minus cost of goods sold gives you gross profit, minus operating expenses gives you operating income. And then obviously operating margin is just the percentage of that. So back to our $100 thing, $100 of revenue, $25 of cost of goods sold. So your gross profit is $75 or 75%. Let's say there's another, $50 worth of operating expenses. Now your operating income is $25, right?
Because you've spent $25 to make your product. You've spent $50 to run your business.
Correct.
That's $75 that you've spent, and you have $25 left over after making your product and running your business.
Right.
So
your operating margin would be 25%.
Right.
We're not done yet. The next ones don't take a lot of explanation, I don't think. Interest income. So that's the money, in this case for Nvidia, that's the money they make on, let's say they own stock.
Well, they have all this cash.
Right. It's cash. It's interest on their cash. It's also like short-term, it's all the short-term stuff like marketable securities.
A lot of their cash is in T-bills.
T-bills, thank you. That was what I was reaching for. And then there's interest expense, and that's what the interest they're paying on their debt, for example, right? So if they have issued debt and they're paying the interest on it, that's where you get interest expense. And then there's an other income net. So that's, I don't remember what it is specifically for Nvidia in this case, but that's just other income. So these are the things that are important to pay attention to if the company has a lot of debt, or if they're the kind of company that interest income would be like a huge part of the business. Like this is big for banks. But if you subtract all that out, you'll get income before income tax. So that's basically, again, revenue minus cost of goods sold, minus all the operating expenses, minus all the interest stuff. You get income before income tax. Sometimes this is called EBIT, earnings before interest and taxes. And that's just another, down the line. So let's say that's $10. So now you're down to 15 and your operating income is 15%, right? So we're just subtracting from that 100. And then the last bucket is taxes. And again, you just subtract what that is. And then you finally get to the bottom line, you get to net income. This is all different than cash. This is just GAAP accounting. That's how you figure out the profitability of a company. And then the very last thing you hear talked about is the per share number. So if you take that net income and you divide it by the amount of shares that are out in the world, and there's usually two different types, basic and diluted. So basic is like the exact amount of shares that exist right now, and diluted is like if you were to take into account all of the different shares that have not yet been turned into shares because maybe they're
shares that will be outstanding that
Correct.
have already are already basically owed to somebody.
Right.
Stock-based compensation.
Stock-based compensation, things like that.
Yeah. Right.
So for some companies that's different. For some it's identical because like it's just not that big of a difference. So in the case of what we're looking at with Nvidia, their net income was $31.9 billion. That shakes out to be $1.31 per basic share or $1.30 per diluted share. Diluted share is usually what you hear reported when you get earnings per share.
Yeah.
And it tells you the share count right here. So there's 24, I guess that would be billion.
Yeah.
327 million basic shares and about 24.5 diluted shares, billion diluted shares. So in about 5 minutes, 7 minutes, that's basically a quick way of thinking about the income statement. And just one thing to wrap it up, and then you can tell me if I missed anything. The whole subtract from 100 thing really helped me when I was first learning, wrap my brain around it. It's just different levels of expenses, right? It's like all the money that came in the door minus the cost of goods sold expense, minus the operating expense, minus the interest expense, minus the tax expense. Boom, bottom line. That's what you hear reported. Profitability, net income, earnings. Those are all the words you hear for the bottom line. And then you just divide it by the share count, you get the per share number. What I missed? Anything?
Yeah, there's a few things that I think are really important to remember. Number one of the reasons we chose to do Nvidia is because it is really simple. You start looking at a bank's financial statements, and there are going to be a lot more lines because they're going to be reporting fees-based income, which is like the fees or the revenue, and then they will show some expenses based on their operations. Then they're going to show net interest income, which is all the interest they earn, minus interest expense, which is like the money they pay to depositors, right? And then you get net interest income. So when you're basically selling money, which is what banks do, and you're selling services, it's the operating statements get a lot more complex. So understand that that's just the kind of reality of the businesses that are out there that are going to have more complexity based on, do they earn money from selling goods? Do they earn money from selling services? How do they break it down? All of those things come into play. One thing also that's really common that you don't see on Nvidia's income statement is depreciation and amortization is an important expense to understand what it means. When we get into the cash flow statements, I'll talk about how the cash flow statement and the balance sheet, this is where those things start to kind of intermesh with one another. Depreciation and amortization is the expense that you're taking for a capital cash outlay that you've made, or an obligation like a lease payment or something like that, where you're showing the expense for that thing broken out over an extended period of time. If you acquire a business, if you buy a factory or a piece of equipment that has a 7-year life expectancy, you're going to depreciate that over a period of time.
Yeah,
there may be accelerated depreciation you take advantage of for tax benefits to lower your taxable income during periods, but that's how you show. This is one of those things. It's like you spent the cash in the past. This is how you reflect the cash that went out the door as an expense against the revenue that you're bringing in now.
Right, and like the easiest way to think about amortization and depreciation to relate it to your like personal finances is like, so I think we all inherently understand depreciation if you own a car.
Yeah.
Right. You buy a car for $40,000, you drive it off the lot, it's now worth $30,000, right? It immediately depreciates. But if you were a business and you bought a car, you don't just get to say, oh, I spent $40,000 on a car in Q whatever of this year. You have to say, I bought $40,000, spent $40,000 on a car this quarter, but I have to say for the next however many years that asset depreciates, you have to state it's now worth this, it's now worth this, it's now worth this, which you do inherently if you go to try to sell your car, right? If you sell your car a few years later for 20 grand, it has depreciated all along.
Right.
A business just has to account for that as it goes. It can't just say it's a one-time thing. Amortization, the way I think about it, is like when you pay your car insurance, you pay that on, maybe you pay it once a year, let's just say, right? Or twice a year, or maybe you pay monthly. But let's say you paid it once a year. It's really amortized over the year, right? If it's a 12-month thing that you're covered for, a business would have to spread that, like divide the amount by the 12 months and kind of put it on every monthly
Every
statement.
quarter, they're going to reflect a portion
exactly.
of that.
Yeah. Same thing, just other. It's something that's depreciating, or it's just something that's an asset that you have to spread the value of across quarters.
And as shareholders, these things are important because profitable businesses leverage these tools to lower their taxable income, right? So that's important. Another thing that's not listed here is something called Goodwill, which
we'll talk about that. That's on the.
We'll get to that on the balance sheet.
Let's go there next. Let's do the balance sheet now.
And the reason I wanted to mention Goodwill is because every once in a while you hear about a Goodwill impairment, and that is a loss that shows up on the operating statement.
Yes. So, yeah. And this is where we're not going to get too far into how they're all intertwined, but they are all intertwined. So yes, even though we're going to talk about Goodwill on the balance sheet, if you take a Goodwill impairment, that's when you see a company that's like usually profitable will suddenly have like a net loss of $30 million out of nowhere. And it's usually because of like a Goodwill impairment, just a one-time thing that they have to say, all right, we're writing off the value of this thing that we, no longer think is valued at this level. All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
All right, so we're going to dive into the balance sheet next. So while Jason's pulling it up, he's going to kind of lead us through this, but I'll just kind of set the stage. The best way to think about a balance sheet is it's a snapshot in time. This is all of the company's assets, things it owns, and all of its liabilities, things it owes, as of the date that's on there. So in the case of this Nvidia one we're looking at, this is the assets and liabilities as of the end of Q3, so October 26th of 2025, compared to the end of the fiscal year.
Right.
Some companies will give you the quarterly balance sheet too. A lot will just give you end of the last fiscal year to the end of this quarter, which I think is frustrating, but that's how they do it.
Well, it's a requirement under GAAP that they do that. So,
yeah.
And in the case of Nvidia, it's its financial period, its fiscal year, ended January 26th of 2025.
Right.
So the period we're looking at ended October 26th, 2025, compares to where all of these different assets and liabilities were on January 26th, 2025. Now that's different. And for those that are watching, you're going to see on the the income statement, you'll see that it compares the 3-month period that they just reported to the year-over-year period. And they also, in the case of Nvidia, show the 9-month period compared to the year-over-year period. On the Qs, they don't always do this.
Right.
Often they will just show the quarter. They don't show the accumulated 6-month or 9-month period of time. So just one thing that was different there that I wanted to share. So, okay. So here's the first thing I'm going to talk about, and I'm going to just kind of shrink this a little bit. You see bolded, there's basically 2 sections. There's assets and liabilities and shareholder equity. And we're going to focus on the assets and the liabilities part. And assets, in short, are either money, things that can be turned into money very quickly, like inventory, or amounts that are owed to you by someone. Liabilities, in the real world, we think of a liability as, oh, hey, that's a risk. On a company's balance sheet, a liability is mainly money that you owe to another party. So assets are things that are money or can be quickly turned into money, or money that's owed to you. And liabilities are monies that you owe to someone else. So that's not exactly right.
No, that's a pretty good summary. And they're also,
go ahead.
I was going to say, they're also listed as you read from top to bottom. You'll sometimes hear people say left side of the balance sheet or right side. That's another way it can sometimes be presented. Although I think that might be an old way of doing it because I've never seen it that way. It's just top to bottom now.
Right.
They're also listed in order of at least the assets. And I think you're going to go through this, how quickly they can be turned to cash. So at the very top, you'll see cash. And at the bottom of it, you'll see, the furthest thing, the asset that has the furthest journey to get to cash as possible. That's how it's organized.
Right. That's exactly right. So, and there's some keywords that you'll see. You'll see current, and current in balance sheet terms.
Current assets, you're saying.
Well, current assets and also current liabilities. But that word current, that means within the next 4 quarters, basically is what it means. Within the next fiscal financial year, is what that means. And this is important because we're going to talk briefly about something called working capital in a minute that is used based on those current assets and liabilities. So current assets, again, this is the obvious stuff: cash and equivalents, marketable securities. And for most companies, marketable securities is something like T-bills. Not always. You have the Berkshires of the world.
It can be CDs. It can be
equities in other companies like a Berkshire or Markel. But again, there are things that there is it's either money or there's a market where you can turn it into money nearly immediately. And then you have accounts receivable. Again, that's the big one where money is owed to you. So for a company like Nvidia, the company that they sell their chips to, their GPUs to. Now, it could be distributors, could be retailers, could be the large. And the companies that exist today, it's 4 companies that, more than half of those accounts receivable are going to be those companies. Go ahead, Jeff.
And anyone who's worked in a company probably might already know this, but accounts receivable and revenue are very much tied together. So if for example, OpenAI says we're going to buy $100 million worth of Nvidia chips, that basically that commitment is accounts receivable, and it doesn't turn into revenue until Nvidia gives them the chips. Right. Yeah. So like things come off of accounts receivable and turn into revenue as the process plays out.
Yes, sort of. Because that order might be in place and it may be booked, but it may not be accounts receivable yet.
Oh, no, you're right. No, I'm wrong. Let me say it. Let me rephrase. That's basically Nvidia has mailed the chips. OpenAI has received them and is about to pay the bill. Right. That's accounts receivable.
Or should be about to. Right. Should be about to pay.
But and typically you have like 30 to 90 days to like pay after you receive the chips.
It could be longer. There's so many factors that come into play.
But it is typically within that window, most companies.
The short version is that the company, in this case Nvidia, has provided the good or service to the customer.
And they're waiting to get paid.
They're waiting to get paid.
Yeah, sorry. Right, I said that wrong at first. Yep.
That's exactly it. Now here's the thing. Again, that's not always the case because that's pretty much generally always the case. So inventories, again, inventory is inventory. It's
That's all the chips sitting on the shelves.
and again, it's not the cost of those chips. It's what the company expects it can realize.
The value of the chips.
The value, right? Not the cost, the value. That's a really, really key thing.
And it's not just the completed chips, right? It's the raw materials to make the chips.
Yes.
It's chips that are in the process
Right.
of being made. It's actual finished chips, like
Everything that makes up the inventory.
Correct.
Right.
And that's what you want to keep an eye on with a lot of businesses. Like,
I want to sit on this one for just a little bit of time, because this is a very important one, particularly for companies. Retailers is a good example of understanding inventories, is really, really good, because just to use a relatively recent example, Target, during the pandemic, a lot of retailers, Target included, really, really struggled to get anything on their shelves, because supply chains were broken around the world. A year later, they were buried in apparel that they couldn't unload. And people that follow those sorts of businesses closely, you get some ability to kind of see if a company is heading towards trouble with that sort of thing. If you have a retailer and sales are falling and their inventories continue to grow, they're going to have to start marking goods down, or they're going to have to sell to some of the wonderful businesses out there, like TJX companies,
right,
that are really good about buying stuff cheap that then they can put on shelves and sell. So,
and the other thing too, like especially for Nvidia, sometimes a increase in inventory is actually not a bad thing, and it makes sense. So, for example, for Nvidia, what we're looking at here, they had $10 billion in inventory at the end of January of last year, and then it was almost 20 billion in the end of Q3 of this past year, or this current year, and that's simply because they were building up the Blackwell chip ramp up. So like sometimes it makes perfect sense, and it is good and the right thing to build up your inventory. And they'll usually tell you that, like if you read the statements or you listen to commentary, they'll say, inventory grew by this amount because we were whatever. Lately you've heard a lot of companies build up their inventory to get ready to get around tariffs, right? Like we build it up so we can avoid the tariffs, or to stock shelves for a holiday season, right? If it's a retailer, right? So it's good to know why there's a buildup in inventory too. Just because it's larger doesn't necessarily mean it's a bad thing.
Seasonality and cyclicality are two things to understand. Like if you built a company like Trex, for example, that their business is manufacturing and selling outdoor decking, don't sell a ton of decking in February, right? But they do a ton of inventory buildup towards the end of the year and early in the calendar year, as they start filling up distributor shelves ahead of the spring season that really kicks off. So their cash flows weaken as revenue softens on a sequential basis. But they have to spend that money to build the inventory up ahead of their busy season. So for seasonal businesses like that, it's important to understand. And then you have cyclical businesses, home builders, for example. Building homes is expensive. There's a tremendous amount of raw material that you need, and you need to acquire it and have it lined up. And then once you have a house, as you get it closer and closer to build, you're carrying more and more inventory ahead of bringing a community online. So it's really important to kind of understand what's going on with those companies' backlogs that they report as they're building out their inventory, and we're seeing inventory increase or decrease, and understanding what's going on with the broader cycle. So inventory is a really, really important thing to understand across different industries. So, okay. So again, this is total current assets. Those are the things that we've talked about. Again, things that can be very, very quickly turned into money. And then below that, you have other assets that they have a value, but property and equipment. So for example, this might be manufacturing equipment they use in R&D for testing, as part of their process. It might
office
be
buildings, land,
all of those sorts of things, right? Physical plant, physical property, real estate, that all go into that. And then you can turn them into money,
but not immediately.
Right? Not immediately. And then operating lease assets. This has become this is a thing. There was a change with FASB, which is it's the entity that sets GAAP. FASB, the Fair Accounting Standards Board, made some changes where companies have to disclose lease assets. So behind the operating lease asset is maybe it's a vehicle, right? Maybe it's real estate that they have leasing. But again, these are operating leases, not capitalized leases. There's a difference there. I'm not going to get into that.
It's the right of use, right? It's like
right. Exactly. Right.
Yeah.
Exactly that. And then next we have Goodwill here. So Goodwill shows up here. And the best way to think of Goodwill in short is the additional price paid to acquire something. Maybe you buy a startup, or you acquire a competitor, or some company spins out part of their business and you acquire it. You're paying above what the market price was for that thing, or what the carrying value of that thing was on whoever's books it was that you're acquiring it from. That is Goodwill. And it is essentially what you're saying. This is what this is going to be worth to us in additional profit capability in the future. So this is what they call a non-tangible asset. This is when I said again, the assets are things that you can turn into money. You hope that a company can turn goodwill into money. And essentially, the only way companies will turn goodwill into money is by whatever they bought, leveraging it to generate additional earnings over time. Chances are, if they're selling whatever that thing was, they're going to be selling it at a discount because it didn't work out. They're going to take a loss, and they're going to book a goodwill impairment over on their operating statement. They're going to impair their cash flow. They're going to take that expense, but they're also going to impair the value on the balance sheet. Did I explain that well?
Yeah. I mean, so a good example is you acquire a business. So here's the thing, the company that you acquire, like, you have to kind of internally value it every quarter. You have to decide, okay, we paid $10 billion for this business.
Well, let's use a lemonade stand, right?
Okay. So
there's a lemonade stand, and you're in the lemonade business, and there's a lemonade stand that is worth that is valued on the owner's books at $100. But you think that lemonade stand to you is going to be worth $120, but you think you can buy it for $110. So you buy it for $110. Let's say you get the seller to let you buy it for $110. You have $100 in assets that you're going to spread across your property, plant, equipment, other maybe intangible assets, some of it. But Goodwill, that $10 is going to go into Goodwill. Right. That's what you paid above the trading value of that asset at the time.
And now, if you decide 3 years down the road, man, that was a bad choice, I should not have paid an extra $10. Their lemonade is bad, and no one wants to buy it. You can decide at kind of on whenever you want. In this particular quarter, you're going to take an impairment. You're going to count that $10 as a basically a loss on your bottom line and sort of write it off. Like, nope, didn't work out. That was bad. But there is latitude in terms of when you do that. There's no law governing when it reaches this point or that point. So sometimes you'll see. Well, I mean, within reason, but like, this is the point.
If you were selling off part of that asset.
Oh, if you were selling it, yeah,
you absolutely are going to book that impairment.
But if you're, sometimes companies will book an impairment without selling an asset.
Yeah.
And the reason I wanted to bring this up is sometimes the cynic might say, this was going to be a bad quarter for this company anyway, right? Bad results, revenue slowed.
That's the best time to do
That's
it.
the best time to dump your goodwill.
Yeah.
Like, now's the time to do it. So there is a little bit of latitude in terms of when companies can do it. All right, let's move on.
Yeah. Again, there is some latitude and discretion for a lot of these things. There are. So in the intangible assets is another item that you're going to see. And that's typically things like maybe your brand, IP that you've developed that you use in your business. And in the case of a company like Nvidia, like the CUDA architecture they built, to some degree, some of that might be listed as intangible assets, even though there is a real tangible product in their software. Then you also get to things like deferred income tax assets, all these other little things, again, there's monetary value, but it's harder and harder for you to just take them and turn them into cash, right? So you get all your total assets. Then we get into liabilities, and it's the same thing. It's you invert it. You Charlie Munger invert it here. So the first things that you see are your list of current liabilities. These are the things that you have to repay somebody else you owe money to, and you have to give them that money within the next year, basically, is the way to think about that. Now, I want to pause here and take those current assets and current liabilities because there's something called working capital that's important. Because again, thinking about that business, you want to have enough capital to run your operations and cover your expenses, pay for cost of goods sold, things like that as you're generating revenue. And working capital is generally considered like the bucket of money that companies have freely available. They're not going to have to tap debt or go to, to a secondary offering or something like that to raise additional money. So working capital is simply current assets minus current liabilities. There are different companies out there that for different reasons may have negative working capital, which is not good, but generally are still able to function okay. But in general, you want to see a company have an ample amount of working capital on their books, because you know that you don't want a company that's living on the very edge of insolvency, having to tap a debt instrument or something like that.
So scroll up a second just so I can see. So just to wrap that piece up. So in the case of Nvidia, they have $117 billion in current assets. So they have about $117 billion worth of stuff they can turn into cash within the next 12 months if they need to. And they only have $26 billion of things they need to pay in the next 12 months. So they are absolutely fine, obviously, from that.
There's an argument that this is a company that has way too much working capital.
Mm-hmm.
Yep.
Right. So then once you get past the current liabilities, just like at the top of the balance sheet, you have the longer term liabilities.
Yeah, which generally is going to be things like debt, long-term lease liabilities. Those are almost always the main long-term liabilities that you see. And then you have, so total liabilities is what you have left there. So total assets is, it's pretty simple. There, net assets is going to be total assets minus total liabilities. I'm not even going to get into the boringness that is talking about shareholder equity. So we'll save that for another time.
Yeah, it's a little bit hard to wrap your brain around. It's also not as important as all the other stuff. All right, so we're about 45 minutes in. I think we can quickly hit the cash flow statement and keep this episode under an hour. So while you pull that up, you're going to probably, if not as much as maybe more than with the balance sheet, talk about the ways that the cash flow statement is tied to the other two financial statements. And it also has three parts to it, right? I'll just give the outline, then you can dive in. So it's split up into cash flows for operating activities, and that's where you get operating cash flow from. That's the thing we talk about on this statement the most. Then you get cash flows from investing activities. We'll talk about what that is. And then you get cash flows from financing activities. We'll talk about what that is. But at the very top, the place you start on the cash flow statement is with the net income. So you take the GAAP nerdy accounting metric for profitability, you start at the top, and then you start adding things back in that weren't actually cash that left the business.
Yeah, that's the key. This is where you start. Essentially, what you're doing here is you're reconciling revenue with cash flows.
Yep.
That is really what you're doing. So in the case of most tech companies, stock-based compensation is going to be a big non-cash expense. So you take your $77 billion in revenue, and then you add stock-based compensation to it.
Net income, not
What's
revenue.
that?
Net income, not revenue.
Sorry, of net income, and then you add your non-cash expenses like stock-based compensation, depreciation and amortization. You're adding that back in, and then you'll see in parentheses you're going to see things that were cash out the door. That you're taking out of it. So then you're going to start seeing things in parentheses that are going to be coming out of that net income number, because these might be future expenses. They may be working capital things that are being adjusted. So like things like deferred income tax. In the case of a lot of more businesses, marking their equity holdings to market. Those things, they have to, for GAAP accounting, they have to take that out of their net income or add it to net income.
Unrealized loss. They haven't lost that money yet.
Right.
Or haven't gained that money. Yeah.
So that is a non-cash thing that you can, you factor in or out depending on whether it was a gain or a loss. And then you start adjusting other working capital things like accounts receivable, and inventories that you factor out. So you do all of those things. You add in or remove those different non-cash or cash-based things. And then what you actually arrive at is operating cash flow. Net cash provided by operation activities is the GAAP way to say it. It's what's written in there, but it's operating cash flow. And in the case of Nvidia, its net income was $77 billion. Its operating cash flow was $66.5 billion. So either way, that is an extraordinarily substantial amount of cash. Now, that depreciation and amortization, they're all important, but it's important to remember that the depreciation and amortization, that's a cash expense that you've already made, right? Your CapEx. You've made that CapEx, and that's something that would be under the cash flows from investing activities. If you bought a piece of equipment, you spent money on a hard asset, you bought some real estate. So under net cash, under cash flows from investing activities, that's where you see CapEx. That's where you see that spend. That's also where you see a company that owns marketable securities like T-bills and that kind of things, is they sell those T-bills and buy new ones. Or if they're in the business of owning stock in other companies and they sell and buy that stock, it's going to show up under cash flows from investing activities. And when those things are happening, when they're selling and buying, that's when they're realizing gains and losses. So that's where the gains and losses that you're adjusting out of the cash flows under the operating cash from the operating cash flows part of this, that's where they show up here. I hope that makes sense.
Yeah. So like, if you're Nvidia and you own stock in Apple, maybe you do, right?
Well, Intel, we know that's a big investment that they've recently made.
Okay.
Some of the companies that do the EDA software, they've made big investments. So they own stock in companies.
Right. So they own stock in Intel. On the part of the cash flow statement, that's the cash provided by operating activities. They have to account for the fact that if Intel stock goes down while they own it, it's in the red for them. On the income statement, they have to say that is worth less.
Right.
But they haven't sold the stock, so they haven't lost any actual cash yet.
Right.
So it kind of gets added back in under operating activities. But then if they did sell it at a loss, it would show up under investing activities. Right?
Right.
Like, did I get that right?
The best way to think about it is, again, you book the losses and the gains under net income, whether you realized it or not.
Yeah.
If you've realized it, you've realized it. And you're not necessarily going to see an adjustment on the cash flow statement, the operating cash flow statement. If they've continued to hold it through that period, they will adjust the loss back into earnings. They will adjust they will adjust the loss back into cash flows. They will adjust a gain, an unrealized gain, out of cash flows, right? Now, once they realize a gain or loss by actually doing something, realizing it by selling it, then that's when you're going to see it show up in the cash flows under the proceeds from sales of marketable securities or maturities of marketable securities in the case of like T-bills and things like that, right? So, yeah. But again, so that's where that investing activities, the difference between that and operating activities, this is the cash that you've generated from your business. The cash flow from investing activities, this is the money that you have either generated or spent making investments in marketable securities, making investments in assets for your business, like an acquisition or buying a factory or buying a pickup truck. Or selling any of those things, right? So that's it. You also adjust out, if you buy a business and that business has cash, you adjust out the cash from that as well. And then the last one here is cash flow from financing activities. This is important because sometimes companies have to raise money. They raise money by borrowing it and by selling part of the company. And this is where you're going to see those things. And that includes issuing stock for stock-based compensation. So
Buying stock back.
right, buying stock by repurchases, but also another thing that's tied to stock that involves cash going out the door, and that's paying dividends.
Mhm.
So that's cash in financing activities. And for all of these things, you're going to see cash flows from, which means they've generated more cash for the money, or net cash used, which means that particular bucket there's less money in it than there was at the beginning of that particular period of time. The last thing you'll see on the cash flow statement is cash and equivalents at the beginning of the period and at the end of the period. This one, I don't want to say it's next to useless, but you really have to start looking at all of the other parts of the balance sheet to really, if this number has gone down, okay, well, what's gone up on the balance sheet that's offset that cash? If cash is way up, okay, well, what's happened on the balance sheet that's caused the cash to go way up? Particularly if cash is way up and operating cash flow hasn't gone up a lot. It's like, okay, well, what did they sell? And maybe they depleted their inventory a ton. And it's like, okay, so they shrank their working capital. Now they have cash. What is going to happen with that cash? Or maybe cash has gone down and you're looking like, well, okay, well, their inventory's gone way up. If it's Target and we're worried about a recession, then that might be troublesome. If it's Trex and it's January and they were building more decking to get ready for their busy season, okay, that might make sense. So context around these things is really, really, really important.
Yeah, that's a really good point. Like, so in the case of Nvidia, they had $2.9 billion more cash at the end of the quarter than they did at the beginning of the quarter, but you don't know why unless you go back through the rest of the balance sheet, cash flow statement to see why. What I try to do, especially with the cash flow statement and the balance sheet, is a lot of asking why. And what causes that asking why is big discrepancies, right? So if I see what they had at the end of the last fiscal year and what they have now, and it's drastically different, or if it's a year over year comparison and it's very, very different, then I'm like, oh, interesting. Let me go see why that is. And sometimes there's a perfectly good explanation. Like you saw in Nvidia's inventory almost doubled. But you find out, oh, it's because of the Blackwell ramp. That makes sense. Versus Target, their inventory went up a couple of years ago, and it's because they bought too many large things that people don't actually want anymore. Yeah, that's a different reason to have your inventory go up, right? So the devil's in the details with those discrepancies that you see.
Yeah, it really is. And just to be clear there, Jeff, you said in the prior quarter, it's cash flow statements year over year is the comparison. So that's another important thing, is look at the year over year period. So
but sometimes you will get a balance sheet that has both. You'll get a balance sheet that has the
balance sheet, but the cash flow statement. Sorry,
correct.
Yep.
So all right, that it's hard to do all of that. I mean, that is more than a 50-something minute long podcast to try to actually get deep into all these different things. So hopefully people are still with us. And if you have ideas for where we could go deeper, or if you hated this or loved it, let us know. Again, trying something different here, but it doesn't take a lot to wrap your head around this stuff enough to be dangerous, right? To know enough to be dangerous, right? To get enough understanding that you're not a complete dummy when it comes to the statements. And I think that's what we're trying to accomplish in this short episode.
And my suggestion is to people that this is new to you and it's something you want to get better at. Pick your favorite company and just focus on that company, looking at these financial statements and comparing it to previous financial statements. And honestly, use a tool like Gemini. We've talked about that and we've begun to use it. And you can ask it, you can take that document, you can throw it into Gemini and ask it, give me trends and outliers from this company's recent financial statements. You can throw in like the past 3 years of 10Ks. This is a great time to start doing that as we're getting them, and ask it to tell you, are there clear issues that it sees or things that investors should be concerned about with its financial statements? And then you can use that as homework to go back and start reviewing the documents and seeing it and starting connecting the dots. And you go from like, man, this is just killing me, to this is really simple and I can understand it, once your brain makes those connections, and it will absolutely help you be a better investor.
Yeah, the only other thing I would build upon is if you do use a tool like Gemini, it's also good for explaining what a thing is. Because as we said, we used Nvidia as an example, but you're going to see some companies will have way more lines on the balance sheet and the cash flow statement. Some will have less. And some of them have weird names and extra information. And if you just literally ask an LLM, I'm looking at Nvidia's cash flow statement, what does this line mean? It'll explain what it is, and it'll tell you, actually, it'll probably give you some detail about Nvidia specifically. And then you can even ask it, explain to me what this is, like I'm in 5th grade. And it'll probably give like a lemonade stand example to help you wrap your head around it. So that's another tip and trick there.
The last thing I'll say that we didn't say before, because it's so important to make sure folks know before we do wrap this up, Jeff, is this is for GAAP for US-based businesses or businesses that are listed on US exchanges that file their financial results in GAAP, not IFRS, which is the international standard that most businesses use that are outside the US. So just be aware that there is a difference there. So pick your favorite US-based company if you're trying to learn this. And I think that's it. I think we can wrap it up.
Wrap it up.
All right, everybody. As always, we love digging into these complex, hard things to answer, including things that might have put you to sleep, like financial statements that are so important if you want to be a better investor. So we love giving our answers. Again, they're just our answers. We think this is a pretty great answer to a big one, but the better you get at reading these financial statements and understanding them, the sooner you're going to get to your own answers. And those are the ones that really matter. All right, Jeff, we'll see you next time.
See you next time.